Hi everyone, today we'll be going over accounts February-March 2021, paper 3-2, question number 5. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And question number 5 is part of section B, which deals with cost and management accounting. Now without any further delay, let's get started. Unlimited manufactures one product. Budgeted information for the year 2020 was as follows. So we are given the sales and production units, standard cost per unit for direct materials, direct labor, and fixed overhead. And fixed overhead is absorbed by direct labor hours. Okay. It is the practice of Unlimited to perform variance analysis every year. Now for the first part of this question, we need to define the term variance analysis. So this analysis is just the investigation or study in order to explain the difference between a budgeted amount and an actual amount. Let's write it down. So investigation to explain the difference between a budgeted amount and an actual amount. This concludes the first part of this question. We can now move towards the second one. And for the second question, we need to explain two benefits of performing variance analysis. So like we said before, variance analysis is just an investigation in order to explain the difference, right? And there can be two types of outcome. Either the variance can be adverse or it can be favorable. If we get our adverse variance, it means that our company is underperforming. So by investigating the reason behind it, we could address those problems and take remedial action in order to not let it happen again. Let's write it down. Address the problems for adverse variance or underperformance and take remedial actions. And the second outcome is that the variance could be favorable, which means that our company has overperformed. And in that case, we can understand this strength and then reinforce that strength. That is also a benefit of performing variance analysis. Let's write it down. Understand the strength for favorable variance or overperformance and reinforce the strength. Okay, this concludes the second part of this question. We can now move towards the third one. We are given additional information. Actual results for 2020 were as follows. We are given the sales and production units, direct material, direct labor, and fixed overhead. Now we need to prepare a statement in order to show the flexed budgeted total production cost for 2020. So whenever we're talking about flexed budgeted total production costs, we replace our budgeted units by the actual number of units. So in this case, that's 7,500 units, right? So we will be preparing our budget for these number of units. Let's write it down. And we are only trying to figure out the total production cost. And our cost, as we can see here, is direct material, direct labor, and fixed overhead. Let's write it down. So that's direct material, direct labor, and fixed overhead. Okay, and then this will give our total production cost. Now we were given the per unit cost for direct material and direct labor above, so we just need to multiply that per unit cost with our number of units, which is 7,500. Let's have a look above. Okay, for direct materials, we can see that each number of units require 2 kilos and 1 kilo costs $10. So let's figure out the per unit direct material cost. That is just going to be the total number of kilos required per unit, which is 2. And then we just need to multiply it with the rate per kilo, which is $10. And this gives the per unit direct material to be 20. Now we will repeat the same process for direct labor. We can see that each unit requires 3 hours of direct labor and the rate per hour is 15. So the direct labor rate per unit is just going to be the number of hours required times the rate per hour, which is 15 in this case. And this gives our direct labor per unit to have the value of 45. Now we just need to multiply these two per unit costs with our number of units of 7,500. Let's do that. For direct material, the per unit cost is 20. We just need to multiply it with our number of units, which is 7,500. And this results in the total direct material to have the value of 150,000. And for direct labor, we figured out our per unit cost to be 45 times the number of units, which is 7,500. And this results in the total direct labor cost to be 337,500. And finally, we have our fixed overhead. And fixed overhead has a fixed amount, so we're just going to substitute that. Let's have a look above. We can see here that the fixed overhead cost per unit is 18, and we know that the total number of units is 7,500. So we just need to multiply these two together in order to get the total fixed overhead. So that's going to be 18 times 7,500. Which results in the total fixed overhead to have the value of 135,000. Now we can easily figure out the total production cost by adding these three amounts. That's 150,000 plus 337,500 plus 135,000, which results in 622,500. Alright, this concludes the third part of this question. We can now move towards the fourth one. For the first part, we need to calculate the direct material variance. And remember that we already have calculated the amount of total direct materials according to the flexed budget. So in this case, we just have to figure out the difference between the direct material for our flexed budget and the direct material cost for the actual results, which is 154,000, right? We can clearly see that the actual direct materials cost is greater than our budgeted one. So the direct material variance is just going to be the actual direct material minus the budgeted cost for direct material. And we already figured out that the actual direct material was 154,000 and the budgeted we figured it out to be 150,000. So this gives our direct material variance to be 4,000. Okay, now we need to figure out whether it is an adverse variance or a favorable variance. So the first thing to remember is that direct material is a cost, right? And we require our cost to be less. But we can see that our budgeted direct material was 150,000, but actual direct material was 154,000, which is greater. So this is definitely not the condition that we require, which means that this results in an adverse variance. So this is an adverse case. Okay. Now for the second part, we need to explain the reasons for the direct materials variance. We need to support our answers with appropriate calculations. So we already figured out that the actual direct material costs were higher than the budgeted direct material cost. And the very first reason this could be the case would be due to that the price of direct materials have increased. And in order to figure out whether it's true or not, let's first figure out our direct material price variance. So that's direct material price variance. Okay, and this is just going to be the actual direct material cost minus the budgeted, but in this case our budgeted rate would be the same. So that's budgeted direct material cost per kilo times the number of actual kilos. Alright, so we already have our actual direct material for 154,000 minus we need to subtract the budgeted direct material cost per kilo, which was given above. Okay, right here we can see that direct materials had the rate of 10 per kilo. So we're just going to substitute this value. 10 times our number of actual kilos. And we were given the actual direct material, which had 14,200 kilos. So I'm just going to write it down. That's 14,200. Now the direct material price variance is 154,000 minus 10 times 14,200, which results in the value of 12,000. And we can clearly see that this amount is just going to be 142,000. And in this case, budgeted is lower than the actual. Again, since we're talking about direct material, this is a cost, so we always require our cost to be lower. But in this case, the actual is greater than the budgeted value. So our favorable condition is not met, which means that this again results in an adverse condition. This just means that our direct material price per kilo has obviously increased, right? And that could be the case due to which we got our direct material variance to be adverse. Let's write it down. The price of materials has increased, causing adverse variance. Now we figured out the variance for price, right? But we haven't yet figured out the variance for the actual amount of kilos. So we're going to figure out the material uses variance now. And this is just going to be the actual direct material kilos minus the budgeted direct material kilos, and we just multiply it with our budgeted rate. So that's budgeted rate per kilo. Okay, we are already given the actual direct material kilos to be 14,200. Let's write it down. That's 14,200 minus the budgeted. So let's have a look above. We are told that each unit requires 2 kilos of direct material, right? And we know that our actual number of units is 7,500. So the total direct material kilos would be 7,500 times 2, which is 15,000. Let's substitute this into our formula. Okay, so we can see that budgeted is greater than actual. So I'm just going to reverse their position. So this will be the budgeted and this will be our actual. So that's just going to be 15,000 minus 14,200, and we know that the budgeted rate per kilo is just 10, so that's times 10, which results in the material uses variance to have the value of 8,000. And here we can see that the budgeted is actually greater than the actual direct material per kilo, which means that this is a favorable condition because our cost is definitely decreased, right? Previously, we figured it out to be 15,000, but in actual case, it only went to 14,200. So this is a favorable condition. And this just means that we have been using lesser direct materials. So this could be the case because that materials may be of better quality. Let's write it down. Materials of better quality have been used, resulting using lesser materials. Okay, this now concludes the fourth part of this question. We can move towards the fifth one. For the fifth part, we need to calculate the direct labor variance. Again, this is the same case as above. Previously, we calculated the direct material variance by subtracting our actual direct material and budgeted direct material right here. Now we repeat the same process, but instead of direct material, we're just using direct labor. So that is just going to be our direct material actual and budgeted values. We can see that the direct labor actually amounted to 342,000, but our budgeted value was 337,500. So our actual is greater, right? So direct labor variance would be actual direct labor cost minus the budgeted direct labor cost. That's 342,000 minus 337,500. And this results in our direct labor variance to have the value of 4,500. And this was the actual cost, whereas this was the budgeted cost. And we can clearly see that the actual cost is greater than the budgeted cost, and we're talking about direct labor, right, which is a cost, and we always require cost to be lower for it to have a favorable condition. But we can see that the cost has definitely increased, which means that this results in an adverse variance. Now for the second part, we need to explain the reasons for the direct labor variance. We again need to support our answer with appropriate calculations. So like we did above, we figured out the direct material price variance and the uses variance, right? So for direct labor, we will also be figuring out the labor rate variance. Let's figure that out first. So labor rate variance. Like we did before, this is just going to be the difference between the actual labor cost minus the budgeted labor cost, but this budgeted labor cost will now be based on actual number of labor hours. Okay, we have our actual labor cost to be 342,000 minus, now for budgeted labor cost, since this is based on the actual number of hours, we will just be multiplying the rate per hour to the actual number of direct labor hours. And we can see that the total actual direct labor hours was 22,000. Let's write it down. Now we need to multiply it with the rate per hour, which we were given above. Okay, we can see that for direct labor, the rate per hour was 15. So I'm just going to multiply the 22,000 by 15. Okay, so that's 342,000 minus 330,000. Now this gives our labor rate variance to have the value of 12,000. Again, in this case, we can see that the actual cost is greater than the budgeted cost, which means that this obviously results in an adverse condition, right? And we're talking about rate variance. If this is an adverse condition, this just means that the hourly rate of labor has increased. Let's write it down. The hourly rate of labor has increased. Now we figure out our rate variance. The next thing would be to figure out the efficiency variance. So that's labor efficiency variance. Now this is similar to our material uses variance. So in this case, we are just going to subtract the actual labor hours and budgeted labor hours, and we are just going to multiply it with the budgeted rate. All right, so we have our actual labor hours to be 22,000, right? And we need to subtract our budgeted labor hours. Let's have a look above. But this budgeted labor hours will also be based on the actual number of units. So we can see that each unit requires 3 hours, and we have our actual production units to be 7,500. So the total budgeted direct labor hour would be 3 times 7,500, which results in the value of 22,500. Let's write it down. So we can see that the actual was 22,000, whereas we figured out our budgeted to be 22,500. So I'm just going to switch this like I did before. So that's going to be budgeted labor hour minus actual labor hour. And we figured out our budgeted labor hour to be 22,500 minus 22,000 times our budgeted rate was 15. So this gives the total labor efficiency variance to have the value of 7,500. And we can see that the budgeted labor hour is greater than actual labor hour, right? Which means that this is a favorable condition. And this could be the case due to the fact that labor is more efficient, due to which we are only requiring low number of labor hours. Let's write it down. Labor is more efficient. Okay, this concludes the fifth part of this question. Now for the sixth one, we need to calculate the overhead absorption rate. Let's have a look at our budgeted information. Okay, we are given our fixed overhead, which is absorbed by direct labor hours. And this is the per unit cost, right? Now we just need to divide this unit cost among our direct labor hours. And we can see that each unit requires 3 hours of direct labor, right? So in order to figure out our overhead based on the direct labor hours, we just need to divide this 18 per unit divided by the number of hours required per unit, which is 3. Let's do that. So that is just the rate divided by the number of hours required per unit, which gives our overhead absorption rate to be $6 per direct labor hour. Okay, this concludes the sixth part of this question. We can now move towards the seventh one. We now need to calculate the fixed overhead volume variance. Okay, this is quite easy. So the fixed overhead volume variance is just going to be the difference between the actual units and the budgeted units. And we can see that our actual units was 7,500, right? Let's have a look at our budgeted number of units. And the budgeted units was 8,000, which means that budgeted is definitely greater than the actual one, right? So our formula now is just going to be the budgeted number of units minus the actual number of units. And since we are talking about fixed overhead, our fixed overhead is absorbed by our direct labor hour, right? So we just need to multiply it with the direct labor hour per unit. And then we have to multiply our overhead absorption rate. Okay, so our budgeted units was 8,000, actual was 7,500, and we can see that the direct labor hour per unit is 3, and we just need to multiply it with the overhead absorption rate, which is $6. And this gives our fixed overhead volume variance to have the value of 9,000. And in this case, we can see that fixed overhead is based on our number of units, right? And the greater the number of units, the greater revenue will be earned. So our main motive for it to be a favorable condition is to increase the number of units. But in this case, we can see that the budgeted number of units is greater than the actual, which means that the number of units actually has fallen down, which results in this to be an adverse variance. This concludes the seventh part of this question. We can now move towards the eighth one. We are given additional information. N Limited plans to manufacture another product in 2021. A director suggests that the company should use activity-based costing in 2021. However, another director suggests that the existing cost basis should be retained. Now we need to advise the directors whether or not the company should use activity-based costing in 2021. We need to justify our answer. So we know that under activity-based costing, we allocate all of the fixed overhead based on the activities, which gives a more realistic allocation. Let's write it down. A more realistic allocation of fixed overhead between various products. And we know that activity-based costing results in a more realistic allocation, which means that it also results in a better pricing for each product. So better pricing for each product. But in order to have a more realistic allocation, we would also require the information on activity. And it is really time consuming to collect those information. Let's write it down. Time consuming in collecting information. And since this is time consuming, it would obviously be costly as well. So costly in analyzing information. And we need to analyze the information in order to prepare a cost basis. So to prepare cost basis. Now, based on these factors, we need to make a decision. So I would personally suggest the directors to use ABC. So I'm just going to write down that decision clearly. The company should use activity-based costing in 2021. Alright, this concludes our 7th part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.